zoom in quite well. This is Financial Management. Book is by Eugene Brigham and Houston. Brigham's book is actually legendary in finance and financial management. The real book is called Financial Management Theory and Practice. That was the book which I studied 20 years ago when I was in college, when I was your age, when I was second and third year student. And the book was 1,100 pages. That's where we studied real finance. Now this is known as the Baby Brigham, which is, not the real one. This is tiny little one. It's the short, quick, easy version of it. And that's what we're going to be doing. It's going to be a quick overview, quick survey, maybe for a few weeks, 3, 4, 5, 6 weeks. We're going to begin with chapter 1, 2, 5, and then we see how we go from there. And we move on chapter 1, 1. So we do chapter 1. And now we have section 1. Finance. What is finance? Again, difficult, tricky, but the short, quick, easy answer is money management. The science, the subject of managing money. That's what finance is all about. Finance is about money. How to get it, how to spend it, how to manage it. That's it. That's finance. Now, 1A, page 4. What's the difference between finance and economics and accounting? Accounting is about recording transactions in terms of money. In accounting, you just record it. You say what happens. In economics, you are focused on resources, on real resources, on tables and books and markers and cameras. In economics, you're focused on real assets, on production. You're focused also on households. You're focused also on the government. You're focused on businesses. And finance is in between. You want to deal with the real and the production side of things, but you also want to deal with the money side of things. So finance is a very, very recent field, developed and separated only in the last 20 or 30 years, which has separated recently actually from economics, and has separated recently from financial economics. So modern finance is an outgrowth separated from financial economics. So what do we have in an organization? In an organization you have CFO. Let me see which is this one. This is 1B. 1B. And CFO is simply Chief Financial Officer. Now we're talking about businesses, we're talking about corporation, and usually number 2 or number 3 in the corporation is the Chief Financial Officer. He is responsible for financial decisions. So now we need to say what is financial decision. Yeah, I got a brand new red color. So to write financial decision. And financial decision is a decision about money. To buy or not to buy. To buy a house is a financial decision. To buy this little Sony camera with which we record is a financial decision. Okay? And financial decision is decision whether to spend money or not to spend money, how to get it, and how to invest it, and so on. Basically, financial decisions require the most elementary economic decision of benefits versus cost. In a financial decision, you want to make sure that the benefits will be bigger, higher or more than the cost. And that's what financial decisions are all about. Now, 1C is about finance as a subject. So let's write out here finance and see what is finance as a subject. And the first major field or area of finance is called financial management. Let's write it out in red. I'll just shorten finance as financial management. Now, financial management is actually managing the finances of businesses. Sometimes the business can be small, sometimes the business can be large. Large businesses are usually referred to as corporations, and it's often financial management is known simply as corporate finance. So I put in a good equal sign. It's the same as corporate finance. And in the good old days of 50 or 100 years ago, I'm putting in a new sign, not used, but that's the meaning of simply business finance. Business finance. So, all three, financial management, corporate finance, essentially mean business finance. And business finance is associated predominantly with managing the assets and managing the liability of corporations. That's why finance requires understanding of all assets and understanding of all liabilities and understanding in general of accounting. And that's why the next chapter, chapter 2, is about accounting and financial statements. Number 2, I will be explaining actually a lot more, is the textbook says capital markets, but that's not really good. Now it's becoming obvious that the textbook authors weren't sharp and good enough understanding the differences. And I'll be explaining now for you to understand. The second field is financial economics. And one of those important fields is the one which you've studied. And the one you've studied is called financial markets. So, a subfield of financial economics is financial markets. Okay, so financial markets is an important field of financial economics. A separate, very important field of financial economics is financial institutions. Okay, and the third important field is financial instruments. All right, continues the explanation now. The three together, financial market, financial institutions, and financial instruments, is called jointly the financial system. Financial system we call this the financial system. And now we define financial economics is simply the subject which studies the financial system. All right? So far good? Now we continue with the explanation of what's wrong with capital markets. Financial markets are themselves divided. So I put in here a little blue arrow, and one type of financial market is called capital markets. Capital markets. And number two is money markets. So capital markets is an important part of financial markets. The other important part of financial markets is money market. So all financial markets are divided into capital markets and money market. Capital market is a market for long-term instruments. Long-term meaning maturing more than a year. And money market is financial market, again, financial market for short-term instruments, those that mature within 1 year. So what he tried to tell you is that the second field was basically capital markets, and then he kind of like says, oh, but it also studies financial institutions. They didn't mention that it actually studies stocks, bonds, and other financial instruments like derivatives. So the correct answer is, the second important field is financial economics, which studies the financial system, whose elements are markets, institutions, and instruments. And markets themselves are divided into capital markets and money markets. And that's number two. The third one is investments. And investments is simply the decision or the purchase of financial instruments. The purchase of assets for the purpose of return. The key to investments is return. In investments, the concept of profit does not exist. There is no such concept in investments. Concept of profit is not exist. For investments, the only thing you get from investment is return. Now the return's got the part of capital gain and interest and rent and so on. That's a separate subject. But to understand is that in investments, you get return. In business, when you have economic operation, you get profit. So profit is an economic concept. Return is the financial concept. Okay, so these three are the primary in finance. Now, within investments, requires understanding of financial management and requires understanding of financial economics, and you need to understand both. That's why investments is considered to be a much higher level course, much more difficult. You need to know completely management, and you need to know economics, and only then you can handle investments. Now let's move on to investments and see some fields with investments. That's right, 3A. In 3A they have security analysis. In security analysis is simply trying to determine the fundamental value, we also call it intrinsic value, trying to determine the value of securities. Okay, and here's now another key. Let's write out here, over there in that corner, that security. is exactly the same as financial instrument. And financial instrument is exactly the same as financial asset. And financial asset is an asset which is someone else's liability. We covered this long time ago. Stocks, bonds, and usually financial derivatives will be the primary financial assets. We also include here currencies like dollar, yen, yuan, the old days Deutschmark, which is no longer existing, euro, and so on. So all of these are financial assets. So security analysis attempts to determine the value of financial instruments, or we call them securities. The next one is called portfolio theory, 3B. So, we need to say what is portfolio, and portfolio is simply a collection of investments, a group of investments, a group of assets taken together. So portfolio theory is basically how to join, how to use collectively different investments, how to combine them for proper return, for proper risk and proper return. So portfolio theory is the subject of how to construct an investment portfolio. Security analysis is associated with analyzing one particular security, one stock, one bond, one currency. Portfolio is about how a number of stocks, bonds, and different securities jointly will behave. Okay? So this is significantly more complicated because it involves many. Usually you will need security analysis for each security, and then you analyze them jointly when you combine. What else you have? Oh yeah, market analysis. When we say market, we can also mean and say sometimes financial market analysis. Basically analyzing financial markets. Is the stock market now good or not so good? Are the prospects really good or maybe not? Okay? So when you do financial market analysis, you need to do economic analysis. When you analyze financial markets, you need to understand the macroeconomy. So market analysis requires complete understanding of macroeconomy and the overall economic environment, and only then you can understand financial markets and their behavior. Again, you may buy a particular stock and you think that the stock is really good, but if the whole economy is going down and the stock market is going down with the economy, your stock is also likely to go down with the stock market and the economy. Okay? And that's what happened during the global financial crisis. Everything went down, no matter how perfect your stock was. Okay? Real estate went down, no matter how safe your real estate was. You can have it in downtown Taipei or worse, in downtown Dubai, and your property would crash. Okay? So, it's important to understand the market, and then you can understand the behavior of securities, of currencies, of stocks, of bonds. Right now you need market analysis for debt to determine, is Greece going to default? Sure, that's the easy answer. The question is, are investors going to lose 40% or 60% of their bonds? Well, what about Spain? Is Spain going to default? Well, is it going to be bailed out? Okay. Well, what about Italy? So you need to understand markets and before you can do any kind of meaningful analysis. And for markets, you need financial economics. There's no way around it. Next, behavioral finance. 3D. And behavioral finance is the subject of finance which studies human nature and how humans make financial decisions. Because humans are sometimes affected by emotion and they make a wrong decision. Sometimes they are affected by love and make the wrong decisions based on love. Sometimes it's based on passion. Most commonly in finance, it is based on ignorance and on stupidity. They think they know when they actually don't know. Like most real estate investors learned the hard way. They thought that real estate never goes down, but it went down, okay? So these are the problems where people are overconfident. They think they know too much when in reality they don't know very much. It is amazing. I've seen it so many years now. I talk to so many people. Never ever had accounting class. Never had economics class. Never had, let's say, even finance class. These are sometimes, and I don't mean to offend any particular, intelligent doctors, mathematics professors, extremely well-educated people. They somehow think they know about it. It's amazing when I talk to, let's say, doctors, how they talk confidently about the economy because they don't know much. When I start talking to them about health issues, they're shocked and say, how do you know? You're a finance professor. You can't know much about health. So when you start talking with doctors about health, they say, no, 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 you don't know enough. You have never studied medicine. So I didn't study medicine, and I'm not supposed to know anything, but they never studied finance, but they somehow think they know finance, okay? So that's extremely common. The most common group which I've discovered think they understand finance best is engineers. They think they know how the world works, and therefore they can quickly figure out how the economy works and how investment works, and they believe that it's just a mechanical system, but it's not. And the reason is that it's based on humans, not laws of physics. And humans are not perfectly rational, okay? We studied this in the other class. Like politicians, they don't believe the problems are too big, or they're not smart enough to evaluate the problems. All right, well, there's that weird thing somewhere called, in the next paragraph of the textbook, called banking. Well, banking is clearly part of financial economics, and it's clearly part of financial institutions. And financial institutions are divided into banking institutions and non-banking institutions. So, the separation of banking is not really good in the textbook. And the last one which the textbook completely missed or forgot or didn't consider, and I'll write for you, which is a relatively new field now to be understood, more important, which is, we still don't have the books, we still don't have it in the curriculum around. It's called personal finance. Personal finance. Is the subject of finance which studies the finances, the money matters of one particular individual or of a family. In other words, finance for the household. Remember, this is financial management is finance for businesses. It's studying how businesses manage their money. Well, they have a separate subject studying how families manage their money. Now, let's now discuss another little miss in the textbook, is the origin of finance. And the origin of finance was, it began to exist hundreds of years ago because the people with money needed to manage them. And the people with money back in the old days were the kings and the countries and the governments. So the origin of finance was about managing the money of the government. And the subject is called public finance. Number 5. In the very first, many hundreds of years ago, this was designed and started as the subject of how to manage the money of the king. Then it grew as the subject of how to manage the money of the kingdom. Okay? And later on grew into how to manage the subject of the country in general. And now, today, in modern day, is the subject of the managing money of the government. So, this focuses on government, this focuses on households, this focuses on businesses and corporations, and over here, you got a subject which focuses on commercial banks, because commercial banks in many ways are special. All right, let's see what else we got. Jobs in finance, plenty of jobs. If you know it, if you understand it, and if you study not from the skinny textbook, but you study from the fat one, okay? If you study from the fat one, plenty. Book says banking, investments, insurance, corporations, government, plenty of jobs. The world is hungry for people who know and understand finance. Section 3 is forms of business organization. I'm not going to be spending much or any time on it. The first one is proprietorship, business run by one single person, no more. Second, partnership, business run by 2 or more partners. That's it. Next one, the more important for today, is corporation. A separate legal entity with all the natural rights to own, to buy, to sell, to contract, and everything else. A separate legal entity registered and recognized by the state with all its own separate rights. And within there, the key is limited liability. The owners of a corporation can lose as a maximum their investment and no more. Their liability is limited to their initial investment. Stock prices versus shareholder value. Well, the meaning of business, the purpose of business is to make money. What does it mean to make money? That's the most common phrase used for hundreds of years. It simply means, we call in finance, to generate profits. Okay? In other words, to generate more revenues than expenses, and whatever is left for the owner of the business, for him to keep. When he generates a profit, he can make 2 things. He can use the profit in 2 ways. One is reinvested, and we call this retained earnings, and the other one, take it and use it for himself, which we call dividend. Okay? So, what's the purpose of a corporation? Well, the purpose of a corporation is actually, it's a little tricky. Usually they say it's to maximize profits, but the reality, it's actually to maximize its owners' wealth and welfare. So, the purpose is maximizing shareholder wealth. And how do you maximize the shareholder wealth? Answer is simple. By maximizing the share price. The share price, the return on share, okay? So, the goal of financial management is maximizing share price. That's it. We have concepts like, let me write some concepts over here, which I have marked for you. The first one is shareholder wealth. So we need just to say in economics, what is wealth? And wealth is simply all the assets owned by an entity. So my wealth is all assets which I own. Okay? The king's wealth is all assets that he owns. So shareholder wealth is basically whatever the shareholder owns. So that's the shareholder wealth. Okay? This is the value of the assets owned by the shareholder. Next one is shares outstanding. A corporation issues shares. A share represents a part ownership. Shares outstanding is the number of shares which are sold to the public and owned by the public. That's it. Number of shares owned by the public. Okay? That's it. That's shares outstanding. Next one is market price. Actually, we like to call it share price. And share price is the price for which you can sell a share on the market, on the stock market, on the financial market. That's fairly straightforward. Now this turns out to be the most difficult concept in finance because value is the most fundamental concept both in economics and in finance, and actually for humans and for different people value has different meanings. Very difficult, very tricky. So we like to use what's called fundamental value. And again, it's very tricky to define because, how do we define it? Fundamental value is exactly the same, and another name is called intrinsic value. And one way to work around is, this is the value of an asset. Could be stock, bond, real estate, gold, okay, currency, if all information is known to all market participants about it. If everybody understands that this house, the foundation is cracked, then they will put in a particular value on it. If everybody understood 2 or 3 years ago the true debt which Greece as a country had, that they were way too much in debt, that will be basically the fundamental value or intrinsic value. And the fundamental or intrinsic value in finance is based or calculated as a discounted value. Which is the present discounted value of all future cash flows. So, fundamental value intrinsic value, all are associated with all future cash flows. An asset is as good as its future cash flows. And its value is determined by all of its future cash flows. And then we say appropriately discounted, or discounted with the appropriate interest rate or rate of return. Okay? So these are all tricky, but basic and fundamental. All right. And the next, or actually the last concept in finance, of course there's a full chapter, is risk. And risk is simply the probability of unfavorable outcome, of an outcome which is not favorable. In other words, it's the risk or the probability of things going wrong. Okay? Remember, for one person, risk is a loss, but on the other end, it might be a profit. Okay? The risk of oil crashing down from $90 to $50, is it really a risk? Well, not for the Taiwanese economy, it's not. Taiwanese economy is consuming oil. Taiwan would love to see the price of oil going down to 50, because you're all going to be paying a lot cheaper than that. That's the risk for Saudi Arabia, which is exporting oil, okay? So for them, it's a terrible risk. For you, it's a benefit, okay? The opposite is also true. One of the biggest risks to the Chinese economy today will be oil going down to 200 or 300 and China not being able to pay for its own oil, okay? Well, is that risk for Saudi Arabia? No. That will be great for them. So, sometimes you have two parties, and based on which side you're on, are you side of the consumer, or are you side of the issuer, or are you side of the investor, or the borrower? So, risk is associated with, always with the side, particular side, investor or issuer, and risk for one, losses, can mean gains for the other party. Is it time? 5 more minutes? Risk? Okay, yeah. Okay, here's another one. Tricky. True risk is the risk associated with a particular asset. We also call it investment, small business. If all information is known about it. If all information is known about it. And then you have the opposite is perceived risk. And it's very simple. People are not perfect. They don't always give the perfect answer on the exam. They don't make the perfect valuation in investments. Sometimes perceived risk is associated with expectations. Expectations of politicians. Are they going to bail out Spain? Or they will not bail out Spain? Are they going to bail out Italy? Well, they don't have the money to bail. Are they going to bail out Portugal? Yeah, probably. So, perceived risk is associated with what investors think, but it may have particular biases based on their age, based on their experience, based on their job, based on their interest, okay? So different people have different perceptions of risk, different background, different knowledge, different information. Some people who are extremely inexperienced in investing in real estate have a very low perceived risk. Real estate is extremely risky investment, but people don't perceive they don't understand the risk. I mean, there are hundreds of risks to talk about real estate, not the time now. Okay, is it good time? Is it finished? And with perceived risk, I am intrinsic value. Okay. Here is the definition. Let me finish with the definition of intrinsic value. And here is what they say. Say is an estimate of a stock true value. We can say of an investment true value. Page 12. Based on accurate risk. In other words, based on true risk and on accurate evaluation of returns. Returns are associated with the cash flow. So, it is based on complete information of future cash flows, correct information of cash flows, and proper risk, also called true risk. So, fundamental value is associated with correctly estimating both the cash flows and the risk. Okay, in other words, both the return and the risk. And that's pretty much it. And we continue next time with 1.6 and later on with accounting. Good enough?